Dr. Michael Burry has gone all in on rising chaos and increasing volatility. Should you heed his warning as an investor for you to consider for your own investment portfolio? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. I talk about all things finance, primarily focused on potential multi-baggers, types of stocks I think can go up potentially hundreds or thousands of percent over time. But occasionally there's something particularly interesting to me, like today's calling out Michael Burry, Dr. Michael Burry's, his investment holdings. And I personally think he's worth listening to. I mean, I've called out several things that he said in the past, but he's, in my opinion, the equivalent of a modern day financial Cassandra, where he sees events unfold before they happen. People, he says, you know what, I think the homes are overpriced. I think there's a bunch of housing bonds that are going to blow up, and people go, you're a dope. And then they blow up, and he's right. And he's like, you know what? It's going to have terrible effects on the economy. He's right. And so he, and he was profiled in the Big Short movie, starring Christian Bale. He bought GameStop before as a meme. He called out the ARK ETFs as having potential liquidity risks and downside, issues before they recently dropped about 35%. And I suspect he sees even further downside from here. Now he's going all in on this new theme, and I think it's a theme. There are several bets that sort of fit that theme of rising chaos and volatility in the years ahead. But before that, let me tell you actually a quick story based on my own personal experience, working on Wall Street, whether or not as an investment banker or a multi-billion-dollar hedge fund, which is that there are 4 times a year where you get to see the holdings of other investors that have over $100 million. It's per SEC requirements, and you have to say, hey, these are what I own. These are my holdings. Now, you don't report certain things. You don't show your international holdings, and you don't show your short positions. But you do show what you are long. And so this is one of the favorite times on Wall Street where you get to see it's almost like playing a global investing card game. And for for 4 times a year, you get a sort of spot check and be like, okay, what cards are you holding? I only can see some of the cards, whatever you're long. I don't get to see, international holdings, which might be a big part of your portfolio or the short positions. But I can see your what you own via stock or what you own via options. And options can be another way of betting against things. And so it's a really interesting time, especially when you're looking for investors, not traders, but investors that generally make bets over a multi-month or multi-year period, is that you might find a good way of poaching ideas. Hey, could this be a potentially attractive idea? You see what Dr. Michael Burry's doing. So here today, he just filed his first quarter 2021 holdings. That was as of the end of March 31st. So there is a little bit of lag, but given that he's a long-term investor, there's the potential for you to potentially capitalize or at least recognize the themes that he's banking on and say, hey, could this impact my portfolio currently? Especially because, he's putting up real money and he's one of the most successful investors of all time. So let me show you his top holdings. And so, going through his top holdings, you see, yes, you do get all the YouTubers and CNBC saying, oh my goodness, he made this monster bet against Tesla stock, saying it's 530 million plus market value. The reality is the amount of money that he's putting up for this is probably a lot less than that, because this is the notional value. This is the value effectively if Tesla dropped to zero, how much money his position would be worth. So the amount of money he's actually putting up is probably some sort of fraction of that. Either, my bet is somewhere between 50 and 250 million would be my thought process on that. But yes, the Tesla put that he bought and owns is his top position when you see it on the notional value perspective. And look, this is not surprising. I did a video on Tesla's valuation, calling out ARK's crazy valuation, in my opinion, on Tesla. So I don't view this thesis as particularly surprising. So you can click on that video if you're interested. Personally, I think it was a really bad look to come out with a model saying, hey, Tesla has this even higher valuation, and then proceed to trim some Tesla shares. But anywho, that's a whole separate thought process. But there's actually a bigger theme going on with what Michael Burry's doing with his investment portfolio, and the number one theme is actually that, look at all these things. These are all call or put options. Normally you see a lot of stocks, but in this case they're options. So these are levered bets on a lot of different things. And why would he all of a sudden be making all these different levered bets across various different securities and industries and tapping into different global macroeconomic trends. And the reason why options are priced not only on the intrinsic value, so like it's priced based on Tesla stock and using the Tesla put where he will make money if Tesla stock drops, but options are also priced on volatility, such that you're saying, hey, what's this option worth over these next few months? Now, the detail of the filing doesn't show, what's the strike price and how many months or even years out these options go for, but a key component of all option value is volatility. And I'd argue this is part of this rising theme of higher chaos or increasing chaos, increasing volatility, where if you own this portfolio and his top holdings are these options, arguably are these options, it does increase the odds that you're effectively saying, oh, I think volatility is going to go up in the future because these options will become worth more. Another key aspect to his portfolio is looking at several calls saying he thinks rates are going to go higher. One is via a put option saying that TLT will go down. TLT is an ETF representing the 20-year government bond yield, and TBT is the ultra short 20-year bonds, and that's a call. So these are effectively very similar positions saying, look, I think rates are going to rise, and that's what he's calling on. He's calling out what I would think is an increasing trend, an increasingly obvious macro call of like, yeah, there's this risk that you have higher inflation and higher rates in the future, in which case U.S. government bonds get sold off, particularly long-dated bonds just aren't pricing it correctly, where you're looking at low single-digit interest rates. So he's looking at much higher interest rates. So number one, higher volatility. Number two, higher rates. Number three, inflation pass-through type of securities. Google and Facebook, the reality is they are inflation pass-through type companies where, look, if you have higher ad spend, you need to be able to spend more for those ad dollars, and your business is, having to raise prices. They are direct beneficiaries of higher inflation. If you're looking at Kraft, if you have to buy ketchup and you're going to go buy the Kraft Heinz ketchup, they're going to be able to pass through those higher input costs over time. And so I look at this portfolio as higher volatility, higher interest rates, and inflation pass-through. This is almost like all a macro bet, with the exception of Tesla. Tesla's effectively like this, hey, this valuation is just kooky dukes. And then, look, if you're interested on Facebook and Alphabet, I actually have done videos on both of them. I personally own both, and relative to the rest of the market, I definitely understand why he's buying call options on both of them, effectively levered bets that he thinks Google and Facebook will go higher in the future. And also relative to their valuation just isn't that crazy, especially relative to a company like Tesla. And keep in mind, maybe he's wrong about Tesla. Maybe Tesla goes a lot higher. But when I did this initial valuation on Tesla, I was sort of saying, look, the reason why there's a lot of downside risk is you're effectively you're pricing in some sort of business lines that just either don't exist yet or haven't developed yet. And that's what ARK does with their valuation, saying this robo-taxi fleet's going to get built out, when in reality you're not really seeing the data points yet really supporting it in terms of rolling it out. You would see it quarter by quarter versus like billions of miles driven by a robo-taxi fleet that they assumed. Anywho, you could watch that whole video, and you know what, maybe there'll be a new business line on helping SNL create higher ad revenue or something like that. And so then another one is, here it is. This is a bet against growth. This is an ETF that he's betting against here. So he's betting against growth stocks, much like Tesla. He's betting on higher interest rates, and he's betting on inflation, higher inflation. And now, why is he betting on chaos? And how am I personally positioning myself as I look at this? And how can chaos effectively affect your personal investment portfolio? So when I look at chaos and I think about the impacts of higher inflation, higher rates, and broadly, why am I saying this higher chaos? Is I think when I think about higher rates, who gets hurt most with inflation? And this has been a point called out by Jeff Gundlach and Stanley Druckenmiller, two, in my opinion, of the world's first-rate investors, world's best investors. And they both make the point that higher inflation, who's that hurt most? It hurts the middle class most, and then it hurts poor people most. So the folks that don't even, can't even tune into YouTube to watch investment channels, those are the folks that are going to get the hurt the most. As Jeff Gunlack articulated, he was effectively saying the middle, with rapidly higher inflation, the middle class effectively becomes poor, and the poor go hungry. And that is a scary thought, because when you have people starting to go hungry, or you have this feeling like, oh, gas prices went up, how can I possibly make ends meet? You get a few more people that are just, make a screw loose, and it does increase the general chaos, in my opinion, of society. It's, let heads roll sort of approach when fewer and fewer people feel like they can make it. And to the point that Stanley Druckenmiller has to say about higher inflation is like, look, the world's wealthiest people, they're going to be ones that figure out how to adapt to it. They're going to be the ones that say, hey, how can we position our portfolio? And that's exactly what you're seeing with, Dr. Michael Burry saying like, hey, how can I position my portfolio to adapt to the times? This is not something that most people can think about. So this is how does the wealthy, aspiring, and wealthy folks adapt to these increasing risks of higher inflation. So one is the societal impact, which is, middle class effectively becomes poorer, and the poor go hungry, and so you have this higher chaos aspect. Another aspect is with higher rates, equity prices get hammered, particularly long-dated, unprofitable companies where the business model is dependent on free cash flows generated in 5 to 10 years from now. So those stocks get hammered. Bond prices get hammered, and that's what Dr. Michael Burry is banking on here with these, I'd argue, sizable bets. Then the major pension funds, the folks that are effectively guaranteeing an income for those retired folks, now they're in trouble. So this adds to the chaos, thesis that's starting to build up here, is because you're looking at these major pension funds, and maybe I'll do a whole separate video on it, where their mandate is maybe 60-40, 60% equities, 40% bonds. Well, bonds right now, they're getting low single digits, and U.S. equities are priced very expensively. So you have this setup of like, man, this could be the perfect storm for many endowment or many institutions, many pension funds that have this promised fixed rate return for their retirees, and they're not going to be able to meet 7-8%, let's say, in the decade ahead, because equities might not do it, and that bond portfolio is going to get sliced with higher inflation and higher rates. And that's effectively what Dr. Michael Burry is calling out. A key aspect to this market rally and what's held up the market so far is the Federal Reserve every step along the way. Oh, okay, we'll print out more money, more QE. Oh, 120 billion this month alone. We'll buy up securities. And that coddling, the Federal Reserve coddling, I think is gone once you start having real inflation and rates start having to move up. When you have, interest rates, long-dated interest rates moving up, and the Federal Reserve is no longer in control. And there are steps that, the early data points suggest it's starting to head that way. Coddling the U.S. equity markets, that's gone. Sort of having a support beam for the equity markets, gone. Then also the profligate government spending, these huge government deficits, that also starts taking a hit when the government starts saying, oh, okay, wait a second, we might have to pay a real interest on these borrowings. And because the debt balance has grown so significantly, that higher interest amount is going to become a larger and larger portion of the budget. And so then, we can't, universal basic income, that's going to be an idea that gets completely tossed out, because they're like, how can we possibly afford that? And so this is, you can see how this creates the dynamics of rising chaos, rising volatility. So how am I positioning myself, as I look at this? And obviously for the full breakdown, you need to go to unrivaledinvesting.com, where each month, the first week of the month, I have a full download of my portfolio, as well as for Journey subscribers. Each month I call out one potential multi-bagger, and that's the goal, is like each month trying to find something that I think can go up hundreds or thousands of percent over time. And that's for the investors that are saying, hey, you know what, I recognize this is a journey. Let's say each month I want to add 3, 4, 5% to my portfolio, and I'm going to try to find ideas that I can sort of layer in and average into in my portfolio. So that's what I'm trying to do with my unrivaledinvestingjourney.com, as well as, an investment community that, on Discord of like-minded investors, and people can share thoughts and share news. But the insights that I have for you, if you haven't subscribed yet, is that there are a few themes that I am considering, which is that for any new investment in size, any material new investment, I'm raising the hurdle rate in terms of what I'm thinking about the risk reward. Previously, if I were adding capital based on the investment environment where just everything seemed to be catching a bid, I would say, hey, my downside scenario would be okay if there's downside of 20%, and my upside, was like 100 and 200%. And, that's sort of the risk reward that I was looking for, is like downside 20, upside 150, 200%. That would be great. Now, because of this sort of thesis of growing chaos, increasing volatility, I'm raising the bar. So that means any new capital that I'm going to deploy in size for my personal portfolio, I personally want to say, you know what, on my low side, I want to have plus 30 to 40, 50%. And on my high side, now instead of, let's say, 100 to 200% over the next 5 years, I'm going to want maybe 300 to 500% upside. So I'm getting more restrictive in terms of what I'm willing to deploy capital into. I want that higher bar, higher hurdle rate. The next aspect is I want more downside protection, and that's covered with what I was talking about in the first point of, like, on my low side, I still want to have meaningful upside. But I want to consider the fact that if you have much higher rates, like Dr. Michael Burry is banking on, then I recognize that valuations might contract. So when I think about any investments, I want to consider, well, what are my current valuations and how much could they contract in the future? Now, of course, things can always go to extremes when people start panicking, as well as the extremes that you saw earlier this year with the SPAC boom, I'd argue. So I just want to focus on what's my downside. And that's part of the reason why for this month's potential multi-bagger, I'm calling out a company that trades below liquidation value that I think still has 200 to 300% upside over time. So that's a perfect example of how I'm starting to position my portfolio as like, oh, okay, if we're entering a period of increasing chaos, increasing volatility, I want to own the names where I have that much more of a margin of safety. If things go awry, oh, okay, well, it's below liquidation value. And I also do for my own personal portfolio, and this is how I personally like to invest, I also do hedge. Now, I just did a video on how you can personally profit from short sellers and short selling. It's not for everybody, and personally, in my own personal journey, I don't short individual stocks. I don't want to short against individual people. That's not how I want to have my journey, but that is how some people do it, and I can understand it. What I personally do is I do a hedged portfolio strategy, and I talk about that in a hedged investing educational video that you can watch if you're an Unrivaled Investing Journey subscriber. So those are sort of the how do I adapt? And in all honesty, that's what life's all about. You have to adapt. It's not who's the strongest or the fastest or smartest. Who can adapt the best to the current environment? And I think adapting to this current environment of potentially higher chaos, higher volatility means raising the bar, expecting the worst. So that means anticipating lower valuations. So think about what are my current valuations that I'm paying for things, how low can my current portfolio go, as well as tools that you can use to try to make money if things start going against you, like having a hedged equity portfolio, or things that you start shorting if things start going down, whether or not shorting indices or what have you. So having a hedge component, but that depends on the individual. So anywho, I hope this video talking about Dr. Michael Burry's first quarter 21 new holdings, his big Tesla short, as well as his, I would argue the more important aspect, the theme of increasing chaos, increasing volatility. I hope this video has been helpful for you. If so, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.